In this video, I'm going to give an introduction to property, plant, and equipment and how it's accounted for. And first things to know is that property, plant, equipment in accounting is also known as fixed assets. So what is property, plant, and equipment? Property, plant, and equipment is defined as tangible assets used for the long term to earn profits. At least that's my definition, and I think it's a pretty good definition. And some examples of tangible assets would be land, buildings, equipment, cars and trucks, things like that. So these are all things that they have physical substance. In a way, you could say you can touch them and you use them for more than a year in your business. If you buy land, you usually hold on to it to make a lot of money with it. You build things on it, buildings, equipment, cars and trucks again. And they're used to earn profits. In other words, they're used in your business rather than being held for resale. So for example, if you're a land speculator and you buy land because you plan to sell it again, then that's not property, plant, and equipment. That land is what we call inventory. Same thing for different kinds of equipment. Let's say you have a computer. If you're using the computer in your business and people are working on the computers every day, then that type of computer would be property, plant, equipment. If you buy a computer because you buy and sell computers, then that's not property, plant, and equipment. That would be considered to be inventory. So the key thing to know about property, plant, equipment, or PP&E, is that it is depreciated. And what is depreciation? Accounting has a very specific definition of depreciation. It is allocating the cost of the asset over the periods that the asset is used. So you can think about it this way. If you have a truck that you paid $10,000 for, and you plan to drive it for 5 years, then you could say that each year costs you $2,000 in depreciation because you're basically getting $2,000 of use out of that truck every single year. And a lot of people think that depreciation is something related to the decline in value. And we'll see later on that the value on the balance sheet of an asset will go down as you depreciate it. But depreciation is not meant to approximate the decrease in value of an asset. It's rather meant to allocate the cost of the asset over the periods that you're used. And a key thing to know is that land is never ever depreciated. I'm not your professor, but professors like to ask that question on tests. So how do you report PP&E in the financial statements? In the balance sheet, it's going to be reported as an asset, and it'll be reported net of accumulated depreciation. What that means is that you would give total PP&E, in other words, the total cost of the PP&E, and then subtract from it your total accumulated depreciation. And you're probably saying, what is accumulated depreciation? I'm going to get to that in a later video. The valuation of PP&E, assets are always reported at their original cost. So basically what you would do is you would accumulate their value at cost, and any increases in cost would not be recorded. So if the value of your PP&E goes up, in US accounting you are out of luck. And the cost itself is going to include all the costs needed to get the asset ready to go. So that's not only the cost of buying, let's say, a computer, but it might be the cost of shipping the computer to your office or setting the computer up. That would also be included in the cost of PP&E. Now, whenever accounting professors talk about PP&E, they also talk about what's called intangible assets. And intangible assets have long life, in other words, more than a year, usually, but they don't have any physical substance. So the classic example of an intangible asset is something called goodwill. And goodwill is recorded only when you buy another company. You can't just say, my customers love me, so I'm going to book goodwill. People go to jail for doing that. So patents, if you invest in patents, especially you buy them from other companies, trademarks, software licenses, something called leasehold improvements. What a leasehold improvement is if you rent space and then you spend money to fix it up. So you might have a 10-year lease on your building and then you paint the walls. So technically you don't own the paint on the walls or the carpeting on the floor, because you don't own the building. So you don't own anything attached to the building either, but you're entitled to use it for a period of time, and therefore it belongs to the landlord, but you're allowed to use it. So therefore that's considered to be an intangible asset. And intangible assets are not amortized, are not depreciated rather, they are amortized. And amortization is pretty much the same thing as depreciation, it's just a different word. And goodwill is never amortized. Another thing to talk about when we talk about PP&E is something called impairments. And basically what could happen is the value of PP&E could go down. And you don't want to leave it on the balance sheet at a higher value than it's really worth, because that would mislead people. So let's say you have a building and it's on the balance sheet at cost of $1 million. And let's assume there's no accumulated depreciation yet. And let's say it's really worth $700,000. It would be misleading to tell people, especially your investors on the financial statements, that this building is worth $1 million when it's only worth $600,000. And therefore what you would need to do is you would need to write it down to its new value, and that write down is called an impairment loss. And what you need to do is you need to test all of your PP&E at least once a year. You also need to test your intangibles too, goodwill. All of this kind of stuff needs to be tested for PP&E at least once a year. And if something bad happens that indicates that an impairment might have taken place, then you may need to test it for impairment a second time that year. You may need to test it for impairment over again. So the journal entry to record a purchase of PP&E would be to debit property, plant, and equipment account and credit cash. So what that would do is, and if you don't remember debits and credits, I suggest I have a great video on this too. See it down below with all the videos on debits and credits. Anyway, PP&E, when you debit it, is going to increase that asset at $10,000, and you're going to credit cash, which will decrease that asset at $10,000. In essence, what you're doing is you're taking $10,000 out of cash, and you're putting it in PP&E, because that's what you just did. And this is what the journal entry would look like for that purchase. If you were to sell PP&E, let's say you bought the PP&E and it's not inventory, but it just happens to be you bought it, you plan to use it, and then you decide to sell it all of a sudden, then you would credit PP&E for the cost, that's $10,000. You would debit cash for the amount of money that you received, because that's an asset going up, $12,000. And the difference between those, a credit of $2,000 would be credited to gain on sale of PP&E. And there's no accumulated depreciation in this problem. I decided to keep it simple. In another video, I have a journal entry that shows accumulated depreciation when you sell PP&E. So you got to watch that video. The T account for PP&E, you would have your beginning balance at the beginning of the year. You would debit purchases. In other words, purchases would increase property, plant, and equipment. When you dispose of or sell PP&E, you would credit the account property, plant, and equipment, and then add all your debits and subtract all your credits, and you get your ending balance. And it's a good thing to know that when you're running a business, you should have the right amount of PP&E. It's important that you have enough PP&E to make money in your business. If you need machines to make money, then you need to have the right number of machines. You need to have enough to satisfy your customers, but not too much. Otherwise, you would have excess capacity, and that's really a waste of money. PP&E does cost money, and that money has to come from someplace, either from your pocket or from another investor, or you may have to borrow the money, and borrowing money entails interest. So it's important to have the right amount of PP&E, not too much, not too little. Most business people err on the side of having a little bit too much, but it may make sense for a lot of business people to have a little less than they need and find other ways when they hit capacity. So that's PP&E. If you like this video, if it helped you, click like below and check out some of the other videos related to PP&E on depreciation and so on. Thanks for watching.